Welcome everyone to week 2, part 2 of our case studies in finance course. Today we're going to dive deeper into case analysis. In particular, we'll be focusing on Whole Foods market. We will also explore key financial valuation models, such as the DuPont analysis. As always, feel free to share your questions with me to help enhance your understanding of these topics. For the Whole Foods market essay case, your task is to critically analyze whether the financial analyst's conclusions about Whole Foods market were justified. Your goal is to craft a well-supported argument in at least 3 to 4 pages. Take a moment to reflect on what's truly happening behind the numbers at Whole Foods. What might the analyst have missed or perhaps misunderstood? Be sure to examine key financial indicators and trends before reaching your conclusions. Let's begin by discussing DuPont analysis. This formula is a powerful tool that breaks down return on equity into 3 key components: operational efficiency, which is measured by net profit margin; asset efficiency, measured by asset turnover ratio; and financial leverage, which is captured using something called the equity multiplier. Understanding these components will give you insights into a company's strengths as well as its weaknesses. DuPont analysis is a method for assessing a company's financial performance by breaking down its return on equity. It was reportedly developed in 1919 by an executive at DuPont. This formula helps investors assess the operational efficiency of 2 comparable companies by highlighting their strengths, weaknesses, and the key factors that most influence return on equity. Let's break down the key components of the DuPont analysis and discuss how they contribute to our understanding of a company's performance. Net profit margin. This is one of the most basic yet important measurements of profitability. It shows how much of a company's revenue actually turns into profit after all expenses have been accounted for. A higher net profit margin indicates better efficiency in turning sales into actual earnings. In simple terms, it is similar to asking, for every dollar of revenue, how many cents does the company actually keep as profit? Companies with high margins are generally better positioned to weather economic challenges. Asset turnover ratio. This ratio tells us how efficiently a company uses its assets to generate revenue. It measures the company's ability to turn its investments in assets, such as machinery or real estate, into sales. A higher asset turnover ratio suggests the company is making the most of its resources to drive revenue. Think of it this way. If a company has invested heavily in assets, but those assets are not translating into significant sales, that could be a red flag for investors. Next is the equity multiplier. Also known as financial leverage, the equity multiplier indicates how much a company relies on debt to finance its assets. The higher the equity multiplier, the more the company is leveraging its operations through borrowing. While this can amplify returns, it also introduces greater financial risk. By examining these 3 ratios together through the DuPont formula, we can assess the company's profitability, efficiency, and leverage, and ultimately how well these factors are driving the overall return on equity. Let's break down the DuPont analysis formula, which helps us understand the components that contribute to a company's return on equity. The net profit margin ratio shows how much profit a company is making from its total sales. It is essentially the bottom line profitability after all expenses have been deducted. A higher net profit margin indicates that the company is efficient at turning revenue into actual profit. For example, if a company has a 15% net profit margin, it means that for every dollar of revenue, it keeps 15 cents in profit. The asset turnover ratio measures how efficiently a company uses its assets to generate sales. It tells us how good the company is at making money from its resources. A higher asset turnover ratio suggests the company is using its assets more efficiently to produce revenue. For instance, a retail company like Walmart would generally have a higher asset turnover compared to a company with high value fixed assets like Tesla, since retail relies on selling large quantities of goods. The equity multiplier shows us how much a company is relying on debt to finance its assets, or in other words, its financial leverage. A higher multiplier means that the company is using more debt to fund its operations, which can either amplify returns or increase risk. For example, if a company has a multiplier of 3, it indicates that for every dollar of equity it has $3 in assets, the rest likely funded by debt. By multiplying these three ratios, we get a clearer picture of how efficiently a company is operating using its assets and managing its debt to generate returns for its shareholders. In this section, we'll discuss 3 key valuation models: discounted cash flow, or DCF, market multiples, and the Gordon Growth Model. These tools help us estimate the value of a company and evaluate whether an analyst's financial forecast seems reasonable. When using these models, it's important to think critically. Which assumptions are realistic? How sensitive is the analysis to changes in growth rates, discount rates, or market conditions? Let's start with the discounted cash flow model. This method estimates the value of an investment based on its future cash flows. Essentially, you calculate the present value of expected future cash flows using the weighted average cost of capital, or WACC, as the discount rate. From there, subtract the initial investment to get the net present value, or NPV. The multiples approach to valuation assumes that similar assets sell at similar prices. By comparing ratios like price to earnings, or PE, or enterprise value to sales, you can estimate a company's market value. Each ratio has its strengths and limitations depending on the firm you are analyzing. Enterprise value multiples and equity multiples are the 2 categories of valuation multiples. Locate and review the Investopedia article shown in the reference for a more detailed explanation and examples of how to apply the multiples approach to valuation. The Gordon Growth Model is useful for companies with steady growth in dividends. It assumes dividends grow at a constant rate and uses this information to estimate stock value. However, be cautious when applying this model to firms with unpredictable dividend patterns. The Gordon Growth Model, or GGM, assumes that a company will continue indefinitely and that its dividends will grow at a constant rate when determining the value of its stock. The Gordon Growth Model calculates the present value of an infinite series of future dividends by discounting them using the required rate of return. The Gordon Growth Model works best for companies that have consistent growth rates because it assumes that dividends will grow at a constant rate. Locate the Investopedia article shown in the reference section for additional detail and examples of the Gordon Growth Model in application. Along with the key questions in the case study assignment, consider how different valuation techniques can be applied to your analysis. Evaluate the strengths and the limitations of each method. In May 2014, Whole Foods stock price fell by 19% from $48 down to $38.93 due to lower than expected earnings of 38 cents per share instead of 41 cents per share, and reduced management guidance, which was a result of increased pricing pressure from competitors. Despite this margin squeeze, the company raised its dividend from 10 cents to 12 cents per share. As part of your case analysis, think about how these valuation techniques might influence the analyst's recommendation. What are the strengths and weaknesses of each method, and how could recent actions, such as Whole Foods' dividend increase, affect those valuations? This concludes the current live chat session. As always, let me know what questions you may have. See you online.